Hey guys, how you doing? I'm Kent Tilley, and today I want to talk to you about something that is kind of confusing and involves a lot of math, and that is how are dividends taxed in Canada? And so we are going to have to talk about a lot of math. There's some numbers, but luckily, like we said in the very first K4 video, I hopefully talk slow enough and Ryan can throw up enough graphics that we can actually help you make sense of this. And now in Canada, there are two types of dividends that you can earn, and they are taxed completely differently. So there's eligible dividends, which are paid out, and these are the more common, I guess, dividends that you would understand if you're investing in a non-registered account. You bought shares in a company and they're paying you dividends, and that's part of your retirement income or passive income, like people like to call it. That's one thing, that's an eligible dividend. And then there's non-eligible dividends, which would be, say, somebody like myself that's a small business owner, and I decide that instead of paying myself a full salary, I'm also going to pay myself dividends out of that. And how are they taxed? And then each province obviously has different tax rates and tax credits. So we're just going to use Alberta today, but we'll throw up the graphics when I'm doing sort of the math. The first one we're going to do is eligible dividends. And I'm going to give an example of saying, okay, let's say you have $200,000 invested in, say, TELUS, and TELUS is paying approximately a 5% dividend every year. Your share value is going to go up and down, so the dividends are going to be different. But let's pretend that it was just straight $200,000, paid 5% for a year. You made $10,000 in dividend income. The very first thing that's going to happen is there's going to be a dividend gross up amount of 38%. So you have to times that amount by 38%. So $13,800 is your taxable income. Now this is why they say sometimes dividends can come into play and not be great for retirees. If they have too much dividend income, now your OAS might actually be clawed back because your income on paper is higher than it actually is because it was grossed up by 38%. So it's something that, you know, the odd wealthy Canadian needs to worry about. So we've got this amount that is grossed up by 38%, but then you get a dividend tax credit, both federally and provincially. Okay, so we had $10,000 of dividend income. It was grossed up to $13,800. The federal tax credit is 15.0198%. So 13,800 times 15.0198% equals $2,072.73. The Alberta tax credit on eligible dividends is 8.12%. So $13,800 times 8.12% is $1,120.56. Now, let's pretend that this person is in a 40% marginal tax rate bracket, which doesn't even exist exactly in Alberta, but let's just pretend so we can make the math a little bit easier. So the tax that they should owe on $13,800 in income is $5,520. But now you get to subtract off the tax credits both federally and provincially. So $5,520 minus $2,072.73 minus $1,120.56 is tax owing now of $2,326.71. Now, We know that their income was actually $10,000, not the $13,800 that was grossed up. So the tax that they owe in Alberta on that $10,000 in dividend income, if they were in a 40% marginal tax bracket, is 23.27%. So now let's get into non-eligible dividends, and the calculations work the same way, just the gross up and the credits are different. So in this example, now we're talking to a small business owner. Let's say, they make $60,000 in salary a year, but the remainder of their income that they want to pay themselves is $100,000 in dividend income because that's what their accountant told them to do. And the next video that I'm going to do is going to talk about how I think small business owners should pay themselves. Maybe not exactly how they should pay themselves, but how they should pay themselves to put themselves in a good position now as far as tax owing, plus in retirement. So it's a really, really big question, and I kind of have a differing opinion than most accountants do on this strategy. So that's just something I'll talk about in the next video. If you're a small business owner, you should certainly check it out. So let's say I paid myself a $100,000 dividend and $60,000 in salary. Well, the first thing that is going to happen is there's going to be a gross up. But on non-eligible dividends, the gross up is now 15%. So you times 100,000 times 1.15, and now my income on paper, the amount that I'm supposed to owe tax on, is $115,000 instead of $100,000. But like I said, now we're going to get these tax credits. And why do we get these tax credits? Because the corporation has already paid either the corporate tax rate on that money, or the business has paid the small business tax rate on that money. So this is a way to avoid double taxation for the person and the corporation. I know it's complicated, but that is how it works. So the federal tax credit on non-eligible dividends is 9.0301%. So 115,000 times 9.0301% is $10,384.62. Now the Alberta tax credit on that, and we'll pull up a graph that will show you the different tax credits for each province. So the federal one is always the same, but each province has a different federal or provincial tax credit rate. So Alberta's tax credit on non-eligible dividends is 2.18%. So 115,000 times 2.18% is $2,507 even. So once again, now we're talking about a person in Alberta that is in a 40% marginal tax rate bracket, which would be roughly close. I think it'd be like 41 point something if I paid myself $60,000 in salary and a $100,000 dividend. But like I said, we'll keep the math easy, and 40%. So you've got $115,000 times 40%. The tax owing on that, if it was full income, would be $46,000. Now we get to subtract off the tax credits. So the federal tax credit is $10,384.62, and the Alberta tax credit is $2,507. Now your tax owing on that $100,000 worth of income is $33,108.38, which is easy math, is 33.1%. So you're in that 40% marginal tax rate. So basically you're getting a little bit of a savings, a little bit, but the government with these small businesses paying yourself dividends is basically trying to make it as close to even as they can for a small business owner to rather pay themselves salary or dividends. Sometimes it works out a little bit better to pay yourself dividends from a tax perspective, and sometimes it works a little bit better to pay yourself a salary instead of dividends, and that's always changing. That goes back and forth all the time, but the way that the government's trying to set it up is that small business owners basically pay the same amount regardless of which way they do it. So that's kind of the hope, because your small business would have had to pay 10% on that money before it got taken out anyway. So now your tax rate on that would be 43.1% because your business paid tax on that, rather than if you paid yourself a salary and paid a little bit higher in personal tax. So I know that was a little bit number heavy, but I hope that made sense. If you liked that, please like and subscribe to the channel. We love hearing from you. And if you want to talk about how to set up your income out of your small business, or how to, be more tax efficient with your investments, that's something we'd love to talk to you guys about. So feel free to check out k4financial.ca. We'd love to hear from you. Thanks again for watching. We'll talk to you soon.